Hey, it's AC again. Thanks for tuning into the House of AC. I'm AC, and this is my house. It's a special day today, guys. Well, special to me, it's my birthday. I'm turning 44, and I got myself a gift. I can't wait to share it with you. In many ways, it's a new microphone. I've got my act together now. I got a professional microphone. So this is the dream I'm trying to sell you guys. All you out there wanting to change your financial future, this could be you on your 44th birthday buying yourself your own microphone. So get it, go get on that horse and go chase those dreams, man. This is the dream I'm selling you. You get to do things crazy, amazing things like this on your 44th birthday. So thank you for everyone for all the kind wishes and comments. And this is going to be a very relaxed show, but it's going to be a fun one. So first, just thanks for tuning in, whether it's live or you're listening to the podcast of this, the House of AC podcast. If you're watching this later on YouTube or the House of AC Facebook page, all of that's very appreciative. I like it. I see the views. I know you're coming, and I want to keep delivering you content, and I love your feedback and having guests on that was inspired by something I've said or a book I've read or just want to share a story with my audience. Reach out. We'd love to have you on the show. We all learn from each other. That's why also I created the House of AC Discord. That's a great little forum to talk to other guests on the show and meet new investors and lenders and, talk real estate, maybe some crypto, some NFTs, little things I'm interested in as well. But today we're going to talk about apartment complexes, evaluating deals. This may sound a little extravagant depending where you are in your real estate journey. We just had a great guest, Christine Patini, who had only bought a condo in her primary house before, and then she went out and bought a 6-unit apartment building. And it wasn't that scary. It wasn't that crazy. So check out that episode from 2 days ago. And, that was great. So this is what I want to show you. This world, I love the commercial world. That's pretty much where I operate my own money now is in the commercial real estate world. And it took some convincing from my friend who's our guest today to get into this space. And I'd already done over 100 deals in the residential space, 4 units or fewer. And now it's, now I feel like I'm ready for the big leagues. And part of me wishes that, I started in the big leagues, but, you live and learn, but I want to teach you. And it's not as scary as it seems. And Christine Patney, hey, hi, that's me. That's what she comments. Yes, thanks for joining us today, Christine. And she was a great guest. We're going to have her back. She got a 6-unit apartment in New Hampshire that was, $314,000, makes $842 a month in rent. That's sort of what we're talking about. We're going to be talking about a little bit bigger deals. I'm going to make you guys sort of a fly on the wall of how my partner and I talk about real estate. Like we'll send each other a commercial real estate listing deals, and we'll do it in real time and show you what we're looking at, what catches our eyes. So you just know how real estate investors talk. And, we want to hear your questions and how you would evaluate deals. And nothing we're doing today is an endorsement of any of these properties. We're just looking at them randomly and saying what we like and what we don't like and what maybe more information we'd want on this property. I know you guys have a lot of questions around financing because we're going to be probably looking at some potentially some big apartment numbers, and how do we finance it? How do you raise money? How are these deals done? So I wish I had a drum roll for you, but coming up is my guest, friend, person who's introduced me to commercial real estate, and now my commercial real estate partner, Damien Scott. Thanks for joining us, Damien.
Hey, Alan, how are you doing? Happy birthday.
Thank you. Yes.
Congratulations on the new mic.
Yeah. Well, yeah, man, you helped get me here, man. You found some deals and we've invested together and done a lot of work together. So it's all led to a new microphone. That's
glad I can help.
Yeah, no problem. I haven't fed my family for a week, but I got a new microphone, so it's been great. So Damien, maybe to kind of get the audience to learn a little bit about you, how did you sort of fall into commercial real estate or just real estate in general?
Let's see. I grew up in California, and I played professional volleyball overseas for 7 years after I graduated college. And during that time was kind of like the downturn. I graduated in 2006, so to date myself, but the downturn in 2007/8 in the real estate market, and I was making money overseas and getting all my expenses paid for. So I started looking into real estate, where my family lived in California. My brothers were in Manhattan Beach. My sister was around that area, and eventually found places that were, I'm like, I'll never see this price point again. And for a brand new construction that is, 5 blocks off the beach, it's a 5-bedroom house. I was like, all right, let's see. I'll keep watching it. And eventually got into one of those. It was 3 townhomes that were all together, and lost a bidding war on the one in the middle and ended up getting the end one, which is even better because it's one shared wall. All my friends wanted to live in that area, so I kind of rented my rooms while I was gone. Had my room locked, and then everyone had a cool place to live. And I was overseas for 8 months, and I'd come back in the summer, and can't complain about that lifestyle I had. And then eventually met my wife, moved out here to Atlanta, and now live still here in Atlanta, Georgia. And we sold that house and ended up getting a quad and a triplex. So I started, in the quad triplex area, getting just a normal kind of loan for the house. And we lived in one of the units. It was in the Highlands. We knew that area from visiting there. My wife had worked at University of Georgia. And so it was, hey, we know this is a fun area for the time being until we find a primary house. And, kind of led into the previous owner wanted us to buy another property, and it was across the street, and we built on the back of that. So then we had a duplex and built from the ground up another duplex. And then we had 2 quads and a triplex, and then eventually kind of rolled it into bigger commercial apartments that, Alan actually helped me find the first one. And then it kind of just domino affected. So it went from, I guess you could even date it back to college when I was renting out my couch in LA to someone,
How much did the couch rent for in LA 10 years ago?
Oh man, I think we each had to pay $400. We had 4 people living in a 2-bedroom. So it was like $600 for a 2-bedroom.
Pre-Airbnb. So to recap, you basically were house hacking, right? You bought a triplex, lived in one unit, rented out the other 2. Imagine that rental income was covering your mortgage payment, a big percentage of it, right?
Yep.
And then the seller had some other small multifamilies across the street, 2 doors down, things like that. And he's just started basically assembling these small multifamilies in Atlanta over time. Is that accurate?
Yeah, perfect. And I mean, they were all within stone's throw, so it made it really easy. I did have some property out in Vegas, and we eventually sold that just because I like to have my investments close. Granted, it is, building more in the commercial space and growing a team around us and underneath us. I feel comfortable outstretching into other states and, growing the portfolio that way because I trust the team that we're building. And we also have the luxury of being able to have a team, instead of just self-managing or, bringing our, paying for it all ourselves.
So that's where you're at now. But you got out of sort of the small residential when like a really handsome person came in and bought all your small multifamily. Is that?
Yeah, I was lucky. I had this person that was looking at the units for a client of his. And a year later, I took them off because I found someone to refinance them for me so I could pull capital out for another project I was doing. And a year later, I got a message from Alan Corey, who was that person, on LinkedIn. So social media, and he asked,
was it LinkedIn?
Yeah, it was a LinkedIn message.
Okay.
And just asking if they were still for sale, and I just kind of said no. But yeah, Alan ended up buying them under the condition that he could find me something to roll my money back into because I wanted a 1031 exchange, which I'm sure those have been topics on here. We wanted to defer taxes as the appreciation went up so high and everything like that. So it's been an amazing ride here, and I'm sure everywhere real estate's been going up on the appreciation side, but that's usually nothing we take into account for. It's more on the cash flow side. Right.
So yeah, the quick story. I sold a duplex in Brooklyn, New York, at 1031. I bought from you a two quads and a triplex all in a row. And then we worked together so you could 1031 into a commercial building. So that this we got started together into the commercial space. And what did we end up buying? Was it
a 19 unit? So so the quad and the triplex that we originally bought was just my wife and I. So we 1031 that in. The quad that we built on to create a quad was a joint venture with one of my buddies that I just told him, I'm like, you need to get in on this. It's so easy, and I'll manage a lot of the risk because I'll be on foot and building the construction. So that one we did pay taxes on that, and then later ended up finding an 18 unit that we put that money into, which would have been great if we knew that at the time we had an 18 unit, we could 1031 that money too. But
okay, so we're going to fast forward a bit. So everyone listening, it all started with a condo in Vegas, and then or a couch in California, and then a condo in Vegas, and then a small triplex. So you lived in one unit, and let's see, how many properties do you own now, Damien, or doors, I should say?
So let's see, my wife and I, we solely own 66 units, I think, and then we part own. In total, we part own coming up on 350 just here in Atlanta, and then 163 out in Alabama. And then we also, being in the 4 and 3 unit when we first got here, we self-managed. So then we kind of just kept, as we went to commercial, we created our own management company because we had to do that for our lender satisfaction to have a management agreement in. And we ended up continuing that. So now I have a management company that has 8 employees, and we manage, over 500 properties, or 500 doors, I should say, in the Atlanta and Alabama area.
Yeah. Wow. So that's quite impressive growth for someone who you were holding down a full-time, like more or less a day job throughout this until recently, correct?
Yeah. We, both my wife and I, we coached volleyball for juniors, and, whether it was high school and stuff, but we also did club ball. So like tour ball and travel ball. And so that took up a lot of our time. And then we started backing out of that just because of, we ended up having our kids. We have 3 girls now, and we weren't being, with their practice tournament schedule for club, we weren't able to see our children when they were at school. And then after school, we wouldn't be able to see them either. And we were paying, $1,100 a month to coach. So in babysitting fees. So we did want to get back to the sport, but we weren't going to pay for it and at the mercy of our relationship with our children too. Right. So we want to make sure we had family first.
So this is what happens. This is like a great story. And you hear these stories like, how does someone own 500 plus doors or units? And it's, well, one thing snowballs into the next thing, and then this snowballs into that. And it's like, well, we'll give you got to hire a property management company in order to get financing on this massive, purchase that you're doing. Okay, I'll start my own property management company. Now I've got another project. Okay, well, now I'll hire another employee. Like I would imagine you didn't see this coming 5 years ago. It might have been like, oh, that would be nice to have, but it's just sort of like to me, it's just incremental. Like this happens. Oh, I want to buy that one. How do I do that? Oh, I take, I learn from my past success, and it's just sort of out there doing deals. Is that sort of how you look at it?
Definitely. I mean, there was definitely times where, some of the units, some of the deals we were getting, we needed to put a lot of money into where there's the value add. So it did help to have that kind of full-time job. So our life didn't, and we'd pour a lot of money into those units. I mean, some of them, we're just finishing up one. We just got our, certificate of, completion and certificate of occupancy for a 16 unit that we just fully gutted, remodeled. It had been abandoned for 15 years and boarded up. So, I mean, we're talking new electric meters, water lines, sewer lines, and then everything inside. And, we put that in there, but we had the leisure too. And it's, kind of maintaining, some of those bigger construction adds to just great stabilized deals. We have some good stabilized deals in Atlanta here that help feed renovations on other deals.
Cool. So what I'd like to do, if you don't mind, I'm going to throw, I found there's a website, Crexi, CREXI, that has commercial real estate listing, apartment buildings. I pulled these up 10 minutes before we joined today. And I thought it might be interesting for our viewers to just hear how commercial investors would look at a apartment deal online, and we evaluate it sort of back of the envelope. Are you up for that?
I'll try.
All right. So we're not endorsing any of these apartments. We just looked at them. We're just surface level looking at what's on here. Let me try to. Okay. So I found this 80 unit in Atlanta, Georgia. A couple words I want that people value add multifamily opportunity. So when I hear that, value add typically means it needs work. A value add means fixer upper in commercial parlance. And 80 units in Atlanta, Georgia. And anything jumping out at you, Damien, right off the bat here? Good, bad, otherwise?
No, I mean, one, we want to know the location. It looks, in the picture, it looks like there's pretty good, decent size of property, and it's multiple buildings to kind of create that multifamily subject property. So would kind of want to know the makeup there, because the great thing with commercial and multifamily is that sometimes you can get 28 units in one roof or 31 units under one roof. And that means, yeah, the roof's bigger, but I would only have an expense on a roof for $25,000 instead of 28 different roofs at, I don't know what the residential is, like $7,000 to $10,000, so it's kind of wanting to go through there. I mean, we see some good pictures. And then the biggest thing I would want to do is put in the address and find really the location so that, 2400 and whatever the address is there. I can't even read it. So,
yeah.
But knowing the location, because then I can kind of know comps to just break things down eventually. Rental and just what's sold price per door, because usually in commercial they kind of break it down to, yes, this is a $10 million property, but it's got 80 units or it's 100 units, and then it's like, oh, so they're selling it $100,000 a door. Like they try to break down the lower price of everything instead of showing you the big chunk of change, because they want to. That's how they try to compare them instead of like a square footage in residential.
Yeah, and a couple of things. It's a value add multifamily, but a lot of these photos seem renovated. So what's common in the commercial apartment is they will renovate one unit and to basically prove to the market that a renovated unit can get a higher rental price. And then they'll put a tenant in there at that high price. And then they say, hey, here's a value add opportunity. We renovated one unit and bumped up the rents, whatever, X amount of dollars. Now, if you do the rest of the other 79 units, you can also do it. And we've proven it for you by renovating one. Is that sort of what you see clicking through these photos as well?
Yeah, correct. I mean, they try to show you proof of concept, and then you can kind of be like, here, we're left meat on the bone for you, which it's great, as long as it's priced that way. You want to make sure that the risk and reward is there, so if they're pricing in these higher rents and it's like, well, I'm running the risk of being able to get those rents and I have to put money in for the capital expenditures, which would be the repairs or remodeling upgrades.
And they have the this is interesting. And this is 92 unit community, but only 80 units are offered for sale. So that's interesting that 12 of them are owned by someone else and not selling, or they're keeping 12. But the unit breakdown, 2 and 3 bedrooms, and they've got some called garden apartments, which probably means ground floor. They've got a little garden patio, and then probably above it, some 2 and 3 bedrooms. What do you look for when you're looking at bedroom counts? Is it a 1 bedroom, 2 bedroom, 3 bedroom? Do you have any preference?
Depends on location. This is in that southwest quadrant of Atlanta. And if we put it out there, it's pretty west from downtown. And you kind of look at what rents out there. And I think, that 2-3 bedroom is kind of where you have in the outskirts, you have some families renting in there. So those will kind of go more. Granted, anything that you can get like a 2 bedroom with a 2 bath, you're definitely better value, because then you're not too worried about someone. If it is 2 professionals, they're not sharing a bathroom, which is kind of nice, even if it's a half bath. But, in town, we'd look at, 2 bedrooms. More common is 2 bedrooms and then the 1 bedrooms. And, with COVID, those 1 bedrooms became pretty expensive because a lot of people didn't want to risk finding a roommate, didn't want to live with a roommate then that they didn't know and stuff. So it cut a lot of the renter pool. and kind of segregated apart that way, where it's like people that would normally go find a roommate decided I'm going to get a 1-bedroom. So those rental prices skyrocketed a lot over the past year for 1-bedrooms.
Right. Okay, so going over here a little bit, value add Class B. So a lot of people may not be familiar with classes. How do you look at class? And also, I should say, don't always trust what's in a listing here. I don't know the agent Scott Spalding at all, but his job is to sell this apartment building. So you would want to fact check everything, and sometimes there's inaccuracy, sometimes fat finger things, and not purposely mislead you. But there's usually 4 classes of a property: A, B, C, and D. How do you break them down, Damien?
For me personally, I would put like that Class A as like that brand new construction, right? The Class B is, what we dream our property. Like, I think a Class B would be, this could be this with that value add, maybe, like B minus, but, it's older, it's kept up nice. It has some good amenities, or at least has internal unit amenities, and some good community areas, whether that's, a workout room is not necessary, or a pool is not necessary, but like community areas, dog runs or something like that. And the average upkeep of the property, the buildings themselves. And then C, more of where we see a lot of is, because people that have held the investment for a while that kind of gone down, and it's also the rents in their value, where it's like, they kept their tenants in there. They didn't want to raise rents, and they kind of not necessarily abandoned the property, but they just kept it and maintained kind of the tenants, not necessarily the property. So it's like, right, if they're going to rent it for this, I don't mind keeping it at this. So
yeah. One way is, this was built in 1970 and it's Class B. Every building typically was a Class A at one point because it was a new construction built at one point. This was a Class A at one point, but now it's 50 years old. And so it doesn't have its shine, and it can't compare to an A building out there that's just newly built. But if you renovate it, it's got, some amenities, you're sort of in the B class. And then probably a building that's not as well kept, like you said, would fall into the C class. And then maybe D is an older building that wasn't maintained as well either. And it might be in a less desirable neighborhood, whatever definition you want to use for less desirable. Further away, it maybe have a higher crime rate. It's got more neglect than some of the other buildings, or it's not 50 years old, it's 80 years old and needs everything redone. So it's just sort of a quick snapshot of letter grades. And a lot of investors say, hey, I only want to invest in C grade properties because I can bring a C up to an B. Or I won't, you'll never be able to bring something up to an A unless it's, brand new, but you could bring something up from a D to a C and a C to a B, and that's the value add opportunity. We're there, maybe it's a B plus after we fully renovate, the whole package like this kind of thing.
Definitely.
Right?
Yeah, no, totally agree. And, nothing against this realtor, but I would probably class this as a C.
Yeah.
And again, like, I think we could, if you would pursue this, then like your goal is to make it a B. But again, there are limiting factors on that, like the amount of money you're putting in rent and location, et cetera.
And so what's a common way to market and sell commercial buildings is something called the OM here. You'll see it prominently, big orange button, download OM. That sounds for operating memorandum. And we'll have a look at that. And this is really sort of gives you a little bit more details, much bigger, prettier photos as well. So the subject property, huge parcel of land. I think it's like 24 different buildings here. And it's a little brochure. It's like a sales brochure on the property, and this will tell you the property overview, the aerial overview, and how to contact the agent. So let's dig a little bit here as well. Average rent is $75 per square foot, which is below the market average is $121. So this is where they're telling you the value add. If you do the renovations, you can bump up the rents from 70 cents a square foot to $1.21. Again, fact check all these numbers, but sort of that to me as an investor excites me because you can kind of do the BRRRR method, which is buy, renovate, rent out, and then refinance, and then repeat. So you would want to raise the rents, renovate, raise the rents, and then you get it reappraised. They come back out and say, "Wow, you bought this building for X amount of dollars. Now it's worth so much more," because in a commercial appraisal, they don't care about what other buildings are selling for. All they care about is what income it's generating, the net operating income. So now that you've juiced up that net operating income, they're going to loan you a ton of money on that, and you could potentially get all your money back out and more at that refinance stage. And then that's when you go repeat the last part of the R, and go redeploy that capital again in a new project. And from my understanding, this is your bread and butter, right, Damien? These sort of value add multifamilies.
Yeah, definitely. I mean, we've done all from, like I mentioned in the kind of the beginning, from full gut rehabs to kind of just remodel kitchen, remodel bathroom, upgrade it, maybe throw washer dryers in units, because a lot of people kind of want that privacy. And it is helpful, like compared to like the 4 units and under or single families, like they're underwriting your debt to income ratio. Yeah, they'll take the income from the property, but they'll take out, X%, in the lending, just so that they're covered. In these commercial loans that we go into when we stabilize after all of it, that refinance part of the BRRRR method, they underwrite the property. I mean, we have to qualify for the loan just for net worth and liquidity standards, but they underwrite the property, and it's amazing because they underwrite the property so well that, taking in vacancy rate, taking in repairs, remodels, unit turns, and reserves, and then all your expenses, that they underwrite it that way. And, I'm sure we'll get to the NOI, which was one of the numbers that was on the, it's in here too in the OM, but they underwrite it so that they're, even a property management fee is in there, so that they know if for some reason you don't make your payments and they eventually have to foreclose on you, they can just take it to market and rent it out, and it's going to make money for them because they have a debt service coverage, which if you're in single family or 4 unit loans, it's kind of like the DTI. It's your debt to income ratio, but instead of debt to income, it's the income off the property. So they call it your debt DSCR, which is your debt service coverage ratio. And, usually on those new buys, they're looking to you to cover about, 1.35. So 35% more than your debt after all expenses are paid. So that's making sure you can get it, and they'll loan to that capacity. So when you get those rents to bump up and interest rates go down, you have those opportunities to really capitalize on pulling cash out after you're done with your project.
Yeah, that's what it means right here. Market gross annual rent. They're saying right now this property unrenovated makes $869,000 gross. Net operating income would be taking out all expenses, the taxes, the trash, the landscaping, and everything. But they're saying, hey, we think you can, after renovation, based on our one test of that one unit we renovated, we can push the market rent up to $1.2 million. So you could basically add, $400,000 to your income. So imagine a refinance period when your building makes $400,000. Again, all these OMs are meant to be very optimistic because they're trying to sell the building. You're going to want to double check, make sure that rents are actually still able to reach that, figure out the budget to renovate each unit. I love these sort of projects because you don't have to renovate 79 units at once. A lot of people think, wow, I don't have that money to buy it, then I don't have that money to renovate it. But what you can do, and what we've done successfully is, okay, well, when someone moves out, then we'll renovate their unit. But if they want to stay in the unit as is, then we'll keep them. So you're slowly working up a renovation budget over the months. And then if we happen to have a vacancy, fix it up and then put in a higher tenant. And you can continually test that you can actually get that rent. Markets may change a little bit, and all of a sudden you thought you could get $1,200 per unit, and now you're going to get $1,100. So then that we can go back to the drawing board. Do we want to do as good of a renovation? Do we want to do a cheaper renovation? Do we not want to do a renovation? Okay, well, let's try again in a year. And then you try again in a year, and that time you get $1,300. Okay, then you want to start renovating. So you have all this opportunity to pause, to redirect, to pivot in your investment plan, because you can spread it across 80 units and it's still making you money even if you don't renovate it, because you're going to go in on day one that you're covering, your costs are covered. And as people move out, flip it. At least that's how I approach a lot of these deals.
Yeah, definitely. And on the cost for these things, we do have, there's abilities for lenders out there, bridge lenders that also throw in the construction costs. I mean, sometimes they'll give you, anywhere from 70 to 80% of the acquisition cost, and then also 70 to 100% of your construction costs if you budget it well. And, that'll be a 2-year to 3-year loan with, 2 1-year options, usually, like somewhere in there, there's everything kind of more time changes the yield and stuff like that. It compromises each other, but it's a give and take, and you kind of find what's going to fit for your project. And you can see the rent roll, as Alan was talking about, and what the rent roll is like when their lease ends, what they're paying now. And you can kind of build out. We have a pretty extensive model for us that we use where we can actually put in all the lease end dates, and it will roll those tenants out. And then we can set that unit to be down for X number of months for remodel and a new lease up. And then we build that into our model to know, what our NOI is going to be over time, but then also at the end, and know how much we need to cover in the meantime to float if we lose income because of vacancies.
Right. And so here you mentioned earlier that, the snapshot, the back of the envelope way of gauging a price of a property, because this one is listed as unpriced, which basically means we're not going to give you a price. You just make an offer what you think it's worth. He's obviously saying, well, I found some comps, that were basically selling close to 100,000 per unit. So without him telling me a price, he's basically saying, well, the comps I provided were $100,000 a unit. This says 80 units. So I'm guessing he wants $8 million or around there without saying it. So that's when I look at this, I'm like, okay, now we know he wants it in the $8 million range, he or she or the owner, whoever they've come up with. And so if that's the case, then you can kind of reverse engineer your numbers. What is the rent? What is those renovation costs? What will the lender lend me to do those renovation costs like you described, kind of thing?
Yeah, definitely. So yeah, I mean, I think it's great. They do throw this in here, and again, I think every warning that Alan's giving you about what's in the OM is definitely, you want to fact check it, right? It's just, you want to come up with your own thesis. This is their thesis to sell the property, right? They're not, if they wanted to buy it, I'm sure they would write down a total different setup. So it's really good to kind of go through. I mean, you can go look on Zillow, apartments.com, to find out current rents of that property, neighboring properties, these comps. And, see here, they're going to throw their rent comps in. So they tell you what they're renting at. They'll break it down price per square foot for renting and everything like that. And you definitely want to make sure that you feel comfortable with what's there and what is the most comparable property, because those other ones could be in a total different area or be closer to a shopping center or a park or something else. Or, there's neighborhoods drastically change, within a mile of each other. So you kind of want to know the positives and how you want to sell it. Because I mean, that's when we would go in and check this property out, is how are we going to sell this property to a tenant at the same time? Like, yeah, we did all the fix ups. Like, that's internal. We know we'll make the property look good, internal and external. But what about the neighborhood? Are they going to be scared driving into the neighborhood, or there's a park, or there's easy amenities? Is, here in Atlanta, is it, how close is it to the belt line? Is there growth coming in? What's new that's coming there? Are there, forward growth in commercial space where, people with big, huge companies are coming in, Microsoft or Amazon, jobs, et cetera?
Yeah, definitely. Because that can really sway, an area. Because think about it. This is a large gathering of people to live. They all most likely have jobs that they have to commute to. And most people want to live close to work. So if you can find a property that has a lot of jobs, typically then you're going to have a lot of tenants who want to live there. And so like if a new Amazon headquarters or Microsoft headquarters or something's being built nearby, most likely they're going to be people who now have jobs that want to live close to work and they would love to live in your apartment community. So all those things are really great to consider. If when you're buying out of town, which a lot of these deals, like there's only so many apartment complexes in Atlanta. If some investors have criteria where, it has to be over 50 units or 100 units. That's just their sweet spot, their niche. And there's only so many of those in say Atlanta, right? So then you have to start looking out of town for further deals in order to grow your portfolio. And so this is where this comes in. You're going to want to look at a growing population. Is this city adding more jobs? Are people moving to that city? Are people excited to live in that city? Because that will mean housing demand will increase. Obviously, the reverse would happen. Is this a declining town? Is this a declining city? Is, the car business going out of business in Detroit? Okay, well, then everyone leaves. Like that was a thriving major city in Atlanta and the car boom, and now no one lives there. And people are worried that might happen to San Francisco because the tech boom, made it so expensive to live there that it doesn't even make sense on a spreadsheet to open up your office there anymore. So now they're looking at Austin, Texas, and Miami and Puerto Rico even. So to get all sorts of different tax breaks and growing other cities. So these are all sort of great to look at. Average household income. Obviously, you want to make sure people live in the neighborhood can afford your rent. If someone's paying $1,500 a month, that seems reasonable for a family that making $54,000 and like it's spelled out here. And then here you go, Damon, directly to your point, what's nearby? This guy saying this is in the area. In the area is a very vague definition. Does that mean it's a 5-mile drive? Does that mean it's a 500-mile drive, right? So you're going to have to kind of do some due diligence, but he's giving you some stuff to kind of chew on. He's got the airport nearby, the Porsche headquarters, conventional center, Tyler Perry movie studios, the Beltline connector, and some other commercial stuff. Lee and White, which is a warehouse community turned into a bunch of breweries. Atlanta top employers. So this is directly what we're talking about here. Who's employing who? Where will your tenants most likely potentially work? Are these companies growing? Are they moving out of the city? Are they adding more jobs? And these are the big names in Atlanta right now for sure. And this is sort of how you break down an OM. And we can look at another one unless you have any more questions about this deal that we're evaluating, Damien.
No, I mean, I think we can kind of, I think this is a kind of a good one to kind of see, what we would offer, right? There's no price on it, right? So it's like, would we want to offer anything, or what are we going to price it to? Because I mean, that's the other thing is like the negotiation factor, right? Why can I not pay what you're asking?
Yeah,
here are the things, right? Like this needs to happen. So I mean, if you're looking at, we can just do this easy. We're not going to deep dive into like all the rental comps that we feel like we need to, but if we just use theirs, I mean, like you said, it's $870,000 say of gross annual rent, and then a potential of 1.26. So the beginning of the NOI number, because that's usually what you're going to get underwritten on. So it'll be interesting to see what was their NOI on this. This is so if they had $869,000 coming in
right now. 418 is the 418,000 NOI.
And what was 869 was the other price. So there's something missing there because we would need to see their financials, because if it's 869 and they're getting 418, that means they have expenses of $51,000. So that's pretty high. And just from our knowledge and what we've done and underwritten so many deals, and also, talk to lenders on the stabilized side, and they usually are for market, they're underwriting 40 to 50%. So it's close to 50%, and it's dependent on that area. Why I know that's easy back of the envelope, right? So it's like, now we can use that same number, say it's 50%, their market gross annual rent. If we take it down, half, we're at $630,000. So if we're at $630,000 in NOI, what is what should we be based on? And that's cap rate. I don't know if we've, if you, how.
Yeah, so cap rate is usually the snapshot that everyone talks about. Cap rate is the net operating income divided by purchase price. So how much money does the building make to pay itself, basically? So that's the cap rate there. Yeah.
Yeah. So that so then you can go the reverse way where it's like NOA or your NOI. So your net operating divided by that cap rate. So like, and you can talk to lenders and they'll kind of say what they're underwriting. You'll be able to find other appraisals they can too, or as you get into it, they'll kind of say, hey, this is what things have traded at. This actually puts its own cap rate on the OM. I think at one point it had that, but here in Atlanta, a 5% cap rate is kind of in the middle. Like this is a little west outside of downtown, but if you're at a 410,000, let's say, make it easy, this is their current NOI, right? Their current NOI and a 5% cap rate is 8.2 million, which seemed to work well with the 80 units at $100,000 a door. But then if we can get that if we can actually get these gross annual rents that they're saying in their OM, then you're looking at, what do we say, $620,000 in NOI. So, and then divide that by, the same cap rate. Your cap rate's really not going to change. So then your value by cap rate, by the simple back of the envelope, has gone to 12.4 million. So now you've added $4.2 million of value. But again, remember, that doesn't take in the construction. So there is some growth there. So then we kind of have to take in, what we would loan and what's paying off the loan and how much money would have to come into it to see how much we would get out of it at that refinance, right? So
that's massive to buy something for maybe 8.2 million. And once it's all renovated, and assuming that we can hit these gross annual rents, that you now have a $12 million building. And then imagine that cash out refi where now you're pulling, back out a couple $1 million, probably $3 million. That would pay back any investors that invested with you. You get a new long-term loan that all your CapEx is probably going to be covered moving forward because you just replaced and renovated everything. You shouldn't have a ton of expenses to start with. And you can also ease into it, like I said, a few units at a time. So this is where things get really exciting, and this is where the numbers get really, really big. And this is why this is like Wall Street and hedge funds operate in the commercial real estate, mostly exclusively. Now they're buying large single family homes, but it's these sort of numbers and returns so much better than what you get in residential real estate in many cases. It's just it takes a little bit more expertise. It typically takes some partnerships. It takes having some money. So most people, like we both did, we both started in the small multifamily space, the duplexes, the triplexes, the quads, and grew into this. But this is definitely unlocking a new level, a new achievement in your real estate career to start doing these numbers. And this is when the returns really, really get exciting, and it makes it fun as well.
Yeah, definitely. I mean, it's, a lot more detail has to go into it, but it seems like it's there, and you want to see, and then also see what, usually in this OM, they're going to say how much they're putting in per door on that remodel. So you can kind of price everything out, and, you on that refinance, you're getting a stabilized property, and they're taking in, like you said, before they give you that loan, they're taking expenses for all those costs. Now, the other thing, at our level, and not that we're that big there. I mean, we're pretty small cap, but we have price by economy because we have so many units that the cost for us for repairs and everything, it's really low. So I'm always kind of, pushing the lender to lower my expense rate to really what my actuals are. Because even though my actuals may be less, they still have to do it to market, because again, if they have to take it over, they're going to pay market prices probably. But so our actual operating may be different than what they underwrite, but instead of 50%, we're usually at 35 or under on an expense ratio, which is awesome. So that means there's still 15% more given back to that to the top line, which is ends up
That's huge. Yeah, 15% on deals this size. Yeah, that adds up quickly. And you made a good point. Like the scale and the volume. Like if you're renovating one single family house, you're going to go to Home Depot and you're going to buy a new oven, right? And then how do those conversations go with you, Damien, when you go to Home Depot and say, "Hey, I want to buy 80 ovens"?
Usually they're scared, but it works out. I mean, I go to the pro desk and, I sat there and I'm like, here, this is what we're doing, renovation from day one. Once I moved into like our bigger 19 unit and then we started rehabbing an 18 unit, I went there and I said, look, this is what we're doing. We're redoing everything. So not only all appliances, but drywall, everything. And, we end up working deals with them. And I mean, I have, they call my workers and have us in for breakfast and try to figure out how to make things work better for us, which is awesome. It's great because, that's a huge efficiency. So, I mean, I get multiple calls a day, not just for repair stuff, but for any orders that are going out. And I'm telling them what credit card to go on. So then I can do the accounting on this side, on our construction side. So I get all that all the time and then put it into the accounting, creating journal entries. So everything's tied together right away. And just staying on top of that. But I mean, our discounts, I mean, we get, we're on the pro services side and then we're getting 25% off on stuff. Some stuff I took drywall that some big contractor backed out of when I first started and asking for them, and they backed out of a contract and they were trying to sell these sheets away that were 4x12s, not 4x8s. And we took them at $7 a pop, which they should be normally selling for like 16 at that time.
Yeah.
And then now, I mean, with all the supply chain and the cost of goods going up and all that, I mean, those boards are just super expensive. It's pretty crazy. I mean, just thinking, I mean, people price it to like the OSB, which is kind of like your plywood, and your plywood went from the most expensive plywood you could get to wrap your house was like $14. Now it's like $42.
Yeah, that's insane. I mean, I guess as a business there, just get a warehouse and buy everyone else's canceled orders and just at a discount. But I mean, that's basically what you're doing because, even we're going to need that drywall at some point in some of our projects. Like there's going to be holes in the walls at some point. We're going to do a renovation, maybe not on this project, but on the next. So might as well get the stuff. And that's what I like about these multifamilies. Like you said, you have you can have 30 units under one roof. It's a bigger roof, but you're saving money because you're only replacing one roof. That's much cheaper than 30. And then when you're buying appliances and materials, you're scaling that. And, if you're a handyman, you can actually hire a full-time handyman to work for you much cheaper than you would with a single, family guy who I might be able to get there next week. So there's all these sort of added layers of benefits and, money and time and effort on these bigger things that they actually become easier deals to manage in many cases, I think.
Definitely. I mean, you get then it just relies on communication because then you're just trying to communicate with everyone and make sure that you're staying on top of stuff. But the software out there to help manage helps all of that. And, you talk about handyman and stuff like that. We've grown so that we've actually contracted out all our repairs. So it's just a normalized cost for us now, which makes underwriting very easy for us. And it's also one of those ways where I'm like, hey, well, look, we need to get a better discount on our loan because we have a contracted, not an employee, but it's a contract that covers all our landscape, covers all our repairs. And then all we have to pay is for the maintenance, or the materials. So it's super helpful that way. So again, it's like our actual operating costs are way better than we sometimes get underwritten, but that's fine because all that does is slows down how much we get to pull out. So it's not a big nut that we pull out. I mean, we do, but it's not a big chunk of change compared to what we could on our operating side. But then that means we're actually going to cash flow way more because we're only paying a loan for this amount. And we're actually cash flowing higher than what they predicted, and we're covering. So we're really under our terms and under our detail, we're actually covering the debt service probably at like a 1.7 instead of a 1.35, which is what they underwrite because they're underwriting. And it's not like we're taking things out. We still have reserves and unit turns, and you kind of put these average costs just as they do. We underwrite to what they are, but our expenses are cheaper, and they have to find ways to kind of bump our expenses because we get those. So we usually ask for like the bare minimum of, $250 a unit for a turn, $250 for reserves per unit, per year, and then $250 for repairs and maintenance. And so then that kind of goes, and then, your water and everything like that. So usually in these deals, the value add also, just to mention, is not always just the raising rents or remodeling and raising rents. Sometimes it is repairing, like water. There's sometimes, I walked into one of our purchases and the person had a $45,000 water bill a month. That's huge.
Yeah, that's insane. Yeah.
So that's a month, and it's not because the property was that big. The property should not have been using, comparatively, like I base it off my other units, right? I have a 19 unit that is about $800 in water a month. So, let's just say it's 20. So that's like $40 a unit. So now this is a 31. So it should have been $1,200 a unit instead of $45,000. So I'm like, okay, that's easy. Like, let's go run new water lines, or let's go find the repairs or toilets that are leaking and do all the unit inspections to make sure there's no leaks or people leaving faucets on, and then check all the property for leaks and repair water lines. And then it's like, oh, there's $90,000 in expenses that I just added back in that's not being taken out of my revenue, and that it goes right to my bottom line. And I didn't have to affect anyone's rent. I didn't have to affect anyone's, with remodeling or construction or add any. It was just the simple repairs that probably cost me like $5,000.
Oh, wow. Yeah. It's just a leak in the pipe kind of thing.
Yeah.
Okay, so real quick, we've got about 10 minutes left. I know everyone's going to say this is great, this is awesome, but let's talk numbers. Let's talk financing. Typical deal, how much are you putting down on a property percentage-wise of the down payment?
I think best deals, we're probably putting about 25% down on acquisition, and then probably 10 to 20% on that construction if we're doing a construction loan on that.
Okay, so they'll take the budget, the purchase price, 25% down payment on that, and then whatever the renovation price, 10 to 15% on that, you have to put down, make it part of the payment to get the loan covered. Now we're talking big numbers as we walk through an $8 million deal. Where are you coming up with all this after all this money? Is this just coming out of the volleyball classes that you're teaching?
No, I was paying to do that, remember? So some of it came from before, where we had, our own capital when we went into properties. But, also friends and family, there's, with everything I kind of did that we talked about before, going from a quad and a triplex and adding a quad and then selling it off and going to 19 and then bought an 18. And then, and then my wife and I got a 31 and a 16. My friends in California, like, how are you doing this? We don't have this investment return that you do. Can we get in? And so I let people in. I've always noticed, when I go back to when I lived in Hermosa Beach, when I was playing overseas, I'd be gone for 8 months. I'd come home in the summer. So it's great. Awesome. Best parts of the months of California. Want to hang out with my friends. They had to work. I'm like, okay, well, this isn't fun because I want to hang out with my friends. So I'm like, okay, I got to find ways to make them money, so they're getting in on deals. We have partnerships and stuff like that where deals, and a lot of them want to stay in as equity partners now. Before we did just kind of like hard money loans and then like, here, we'll pay you 15% a year on your loan and then walk away from it if we want to do that. And we'll pay you back, all your money in 2 years and 15% a year. Or now they're like, we just don't want to worry about our money anymore because we have the money. We don't want to have to find a place in 2 years where to put it again. Just keep us in on equity, and they want to run with the ebbs and flows of rental income, et cetera.
So all these major deals, like it always takes investors. It's not, you can be the hustler if you're listening to this and put the deals together and then go find the investors to pay for everything. Like, that's not unheard of. And then you sort of share the fruits of your labor. Now, the thing is, no one's going to invest with you until you have a track record. Like Damien had a track record of buying small multifamilies over and over again. And then he ventured by himself with his wife into a large commercial property, and that was successful. And what does that do? Well, wow, Damien, I want to invest with you. I'm making X amount of dollars in the stock market. You seem to be doing better. Or, hey, I want to diversify. Even if you can match the stock market, I'll be happy to invest in you. So just know that it takes your reputation. It takes experience. It takes doing something and figuring it out. And then people are going to want to naturally say, well, Damien knows what he's doing. He's bought and sold these over the years. I trust him. And so I will invest with him. And as an investor, as someone who does invest and raise money on times to pull off these deals that we do together, Damien, like you're only as good as your last deal. So you better make that next deal work and be successful, because then those investors want to stay in the deal and say, well, that worked for me. Let's do it again. Let's rinse and repeat. And obviously success begets success. And so if that works, then new investors want to come in. And then all of a sudden, you're not looking at $300,000, $500,000 homes. You're moving up to the $1 million price point. After a $1 million price point, then you're like, wait a minute, I've got more investors who are interested, and I've got more experience. I've got a better reputation. Now I can look at the $4 million price points. And then after you do a few of those, then you're in the $8 million price points. And then all of a sudden you're a guy doing, whatever, $20 million, $100 million deals all across America. So it all bubbles up, and it's not like, you can just jump in. In some ways you can, but you can also surround yourself with a team. So maybe if you found a really juicy deal out there, go find yourself a Damien or someone who has experience, and then you can partner up. Or go find yourself someone who has money, who's an investor, and then you go find a contractor. It's just building that team. You don't have to be a jack of all trades. You don't have to fund it all yourself. These are all sort of opportunities out there that you combine. And that's why I'm trying to get all these excited people listening to this on my Discord. Like you can hear me and say, oh, I want to invest in your deals. When is Alan going to tell me? Well, I don't know, because it's usually people calling me saying, I've got a deal. Let's get it done. But let's share those deals with each other on our Discord, the House of AC Discord, or at least join the House of AC Facebook group, follow me online, all those sort of things. It's to benefit you, okay? I'm not just trying to artificially juice my numbers and followers, but the more followers I have, that means the more lines of communication I have to find these deals and share these deals. So thank you, Damien, for coming on the show. This is excellent. I think this is a very good primer on commercial real estate. It is a step that I think every investor should eventually sort of aspire to, but it does start in the small multifamily space. I think I had to do that for 15 years before I felt comfortable doing commercial, and before I felt like I knew what I was doing. Like I became an expert at small multifamily, and then to make that step into commercial, it's a new world. It's a new way of lending. It's a new way of appraising. It's a new way of looking at the numbers and modeling it. But it's not completely foreign to what I've been through in the small multifamily space. So thank you, Damien, for letting me ride your coattails into this commercial world. Thank you for including me. I love being your partner, and it's fun working with you. So would love to have you back on the House of AC in the future.
Same. Happy birthday, and good luck to everyone out there. Enjoy it. Have fun.
Thanks, guys. And follow along at the House of AC, and we'll see you next time. We live stream this every single day, every single weekday. Starting next week, we're going to bump this back a little bit and start at 12:30 Eastern, just so that you guys can go grab your lunch and join me for lunch every day, or go grab your coffee if you're on the West Coast and join me and learn along with us. All right. Bye, guys. See you next time on the House of AC.